Said he.
DJ Hawk, do me a favor, go ahead and stop the music. Thank you very much. Good afternoon, everyone, and once again, welcome to the first Fast Track of 2025. For those that do not know me, I am Peter Benjamin, and I couldn't be more excited to welcome you and to moderate today's webinar. Before we get started, just a few housekeeping items. This webinar will be recorded and will be posted to our website in the coming days. I will be monitoring the Q&A and the chat. Feel free to ask questions and I will do my best to weave them in. And finally, our 2025 calendar of in-person events is published and registration is open for our summit and both workshops. I would also like to add, you should be on the lookout for more information on registration for this year's Make Your Mark annual conference in the next few weeks. Before we jump in, just a quick disclaimer. The views and opinions expressed during this webinar do not necessarily reflect the views or positions of Acuma, its board of directors, its management staff, or its members. The webinar and its materials are presented as an idea and possible strategies regarding a specific topic. They do not represent any endorsements of the presenters, their firms, or the concepts they present. Okay, let's jump in. Today's webinar is being brought to you by ACES Quality Management. Joining us today is Kyle Kehoe, Executive Vice President of Sales and Marketing. Kyle, welcome. Thanks for being here. It's good to see you.
Hi, it's
Now,
great to be
Kyle,
here. Thanks again for inviting me, Peter.
my pleasure, my pleasure. Now, Kyle, 2025 outlook. It's what an interesting year so far.
Yes, for sure.
Now, I think we can both agree that this is an ever-changing environment. It seems to change daily.
Yeah.
And so to that point, quality control, ACE's quality management and quality control, I think we both can agree quality matters more so now than ever. Can you expand on that idea?
Yeah. Well, thanks again for inviting us and
Of
appreciate you
course.
sponsoring these webinars. I think it's a great topic today. Yeah, no, absolutely. Quality is more important than ever. And, I think a couple of things. One is the macro trend, right? I mean, we're in a period right now with typically lower mortgage volume, tighter margins for credit unions. And, if in that environment, mistakes are amplified. So when you find defects or if you happen to have a repurchase event, that can be really costly to a credit union. And so very important to have process in place and technology in place to help you manage it. We talk with a lot of credit unions. A lot have invested heavily in the digital lending experience over the last few years, but yet, they're doing quality control in Excel spreadsheets, and it doesn't really match what they've built in the front end of the process. So this is important to take advantage of, technology, AI, automated workflow, and so forth to really match that sort of front end process to make sure you're catching all those defects.
Funny thing is that I used to work at a credit union where our Excel spreadsheet, if you actually printed it out, it was
Yeah.
20 pages long.
Wow.
Um, Not the most efficient thing, but hey, I'm not gonna say it worked for us, but hey,
Yeah, yeah. Well,
yeah,
we see it a lot. Yeah, for sure. And
yeah.
when some of those equations break or whatever, the formulas it can be a real gnarly experience.
Gnarly is a good way of saying it. Good way of saying it. Let's bring that word back.
Yes.
All right, so I think this is one of my favorite topics. It's a horrible topic, natural disasters, but I think it's a very relevant topic for what we're seeing, in recent months, but something that can most certainly impact a lot of our members. There's been, whether through 2024, towards the end of 20, end of 2024, and even what we saw beginning months of 2025, there has really been a recent string of natural disasters. So I have to ask this. You guys at ACES have to, you probably see this more so than anyone else, but has the recent string of natural disasters affected mortgage quality?
Yeah. Yeah. Well, no, it's a good point. And, we've all seen the horrible news, the floods, hurricanes, the fires, of course, on the West
Yeah.
Coast. And it's had an impact on the housing market, no doubt about it. We at ACES produce what we call the Quality Control Trends Report each quarter, basically looks across the industry and looks at the defects that our clients are finding on mortgages. And in this last report we just published a couple weeks ago, insurance defects, which was always very nominal, increased from 0.65% to over 3%. That's a pretty significant jump. And really, what that means is very volatile in the insurance area. And what we think is really happening here is a lot of insurance premiums are skyrocketing in the industry because of these natural disasters. And that's then affecting the borrower's debt to income ratio, which downstream can then affect their, ability to pay and delinquency. So it absolutely is having a correlation effect there. And even if you looked at the news a couple of weeks ago, there was even a report just in the LA area. I think in January, there were something like 700 borrowers that said they were behind on their mortgages due to fires. And then the next month, it jumped to over 4,000 are now behind on their mortgage due to fire related issues. So, and I'm sure it's probably going to jump again because many
Yeah.
more houses were affected. So locally, it's having a huge impact in that area. But I mean, even nationally, I think we've seen insurance premiums go up across the board And that's having some ripple effect across other areas of mortgage lending. So absolutely.
Yeah, I mean, it's I'm looking at some notes that I took from just doing research and preparation for this. Nationally, insurance has gone up 38% since 2019.
Hmm.
That's ridiculous. And if you break it down, when you look at the actual, PITI, you know, tax and insurance makes up about 10% of the average mortgage borrower's payment. But when you compare that to what it was in 2013, it was only 2%. So there's been a jump. And I think it's impacting their pockets, impacting their ability to afford the house. It's most certainly, impacting quality. And, so I'm really excited to dive into today's conversation with our subject matter experts. It's because I think it hits home for a lot of us more so than what we think, um, about our how we approach our day to day, our members, etc. Now,
Yeah.
last question, before we start transitioning, I was on ACE's website, and I have to ask this question because I'm really interested to know. Tell me a little bit more about the Stand for Quality movement.
Yeah. I appreciate you bringing that up. And, actually, our clients helped us develop this movement. And, ACE has been in the software business for over 20 years, helping clients automate the quality control process. But it's really more than just software. It's really the people, our culture. When we bring on credit unions, we teach them best practices and how to develop quality control, find defects, have quality built into your workflow, into your whole process. And like each spring, we put on a user conference we call ACES Engage. We bring together all different types of lenders, credit unions, big lenders, small lenders, and industry experts from Fannie Mae and MBA and et cetera, and really kind of share best practices across how to develop a quality culture, which is a pretty unique area. And so we ask all of our customers to really stand up for quality. So it's a really interesting event. And it's sort of our mantra this year, and our whole marketing campaign is built around that. But you know what? Even if you aren't a client of ACES, I encourage you to look into more of this. We have a whole website we built on this. So you go to acesquality.com/I stand for quality. And there's a whole guide to building quality at your credit union. You can download it. It's free. All this stuff is free. We have a free compliance news hub, so you can get summaries of all the latest regulation changes in the industry, and also links to all the industry tools out there, even from Acuma and from Fannie Mae and other things out there that are available free to help you develop basically great quality process at your credit union. So I encourage you to check it out and enjoy it.
I'm going to subscribe today. I promise
Great.
you.
Good.
Well, thank you, Kyle. Again, I truly appreciate your time today, and thank you again for sponsoring today's session.
I appreciate it. Thanks again.
Kyle, thanks. It is my pleasure to welcome today's panel of three experts who are extremely well positioned to provide you with valuable insight into such an important topic. Our panel is Mandy Phillips, General Counsel and EVP of Compliance with ACES Quality Management, Val Baresh, CEO of Polygon Research, and Steve Murkison, VP of Property Solutions, Flood Sales with Zactus. Mandy, Val, and Steve, welcome to the webinar. I'm excited to have you here.
Thanks for having
Thank
us.
you.
Of course. Now, Mandy, you don't look like you're at the office today.
I am not. I am on vacation for spring break with my kids in Playa del Carmen, Mexico.
Well, I appreciate the dedication that you are showing to the Acuma community.
Would not miss it. Thanks, Peter.
Of course. Yeah, I had to call you out. I'm sorry.
It's fine. I expected it.
Okay, good. At least we knew going into this, I was going to make fun of you a little bit.
Of course.
Okay, so I think today focuses on equipping our attendees with strategies to support their members and protect their credit unions. This again brings me to why we're here. It's safe to say that our industry, the mortgage and housing industry, continues to evolve in response to various challenges, including natural disasters, policy changes, compliance requirements, and the economy. In fact, you probably could argue that all of these run hand in hand. And when you think about natural disasters, the recovery required for each type, whether it's flood, hurricane, tornado, and fire, they all really require a different approach and consideration. And really both for members and credit unions and their portfolios. So when it came to thinking of things I want to discuss with all of you today, I kind of wanted to focus on three main categories. The categories are disaster recovery and the techniques for supporting members effectively, policy changes and FEMA's role and how this might impact lending, and concentration risk, portfolio resilience in disaster-prone markets. So as we go through, these series of topics, we're first going to start with each topic, and then we'll ask questions within each topic. And then once we're done, we'll move on to the next topic. Okay. And then, of course, I'll allow all three of you to provide final thoughts at the end. And before we jump into topic one, I just want to remind our attendees, please, at any point in time, ask questions in the chat or Q&A. I have both of them up in my other screen. I will monitor. Our subject matter experts are more than happy to answer any questions you may have. I will weave any questions in as we go along. All right, so topic number one, disaster recovery and supporting members effectively. So yes, the Palisade wildfires have been in the news lately, but floods are the natural disasters we typically hear the most frequently. So in general, as from an industry standpoint, how are we managing flood risk as an industry and as a country? And I guess I'll start with Steve, since you are, well, I'll call it the flood expert on this panel.
Thank you. That's kind to call me an expert. And thank you for having me today. It's a pleasure. I think I'd call this kind of a good news, bad news scenario. I think as it relates to credit union compliance with the Flood Disaster Protection Act, things are in pretty good shape. Credit unions, by and large, have solid practices in place for assuring that properties in a special flood hazard area do have and maintain flood insurance. There's going to be some isolated instances of noncompliance, but as a whole, the policies, the practices are in place and followed. I would say, though, there's a huge difference between compliance and flood risk. As it relates to flood risk and as we're managing it as a country, I think there's great opportunity to do better. There's a serious flood insurance gap, in my opinion, and I would say most inside observers' opinion. For round numbers, there's about 5 million NFIP or National Flood Insurance Program policies in place. Another 500,000 to 600,000 private policies. So less than 6 million flood insurance policies in place. We know there's about 9 million properties in the special flood hazard area, so where there's a mandatory purchase requirement. And that's not saying that lenders aren't doing their job. That's telling us that people who don't have to buy flood insurance don't. And that's even in high-risk areas. And if we look at high risk and moderate risk areas, you have about 20 million properties that really could and should be covered by flood insurance. I saw for Hurricane Helene, which ravaged Western North Carolina, in the Western North Carolina region, that were the properties that were damaged with that hurricane, less than 3% had flood insurance. So, that is an area that needs to be addressed is a flood insurance gap. And, all of that, greater than 97% of those people are totally reliant on disaster relief, which is a far cry from the protection insurance provides.
Right. So, when you look at, Hurricane Helene and even Hurricane Milton, from 2024 and their impacts on the Southeast, based off my research, you're looking at about $100 billion in damage combined, right? So that is a significant high dollar amount to any portfolio, right? Or any mortgage portfolio across the board. I mean, obviously, you have hurricane insurance, you have flood insurance that relates to it, but that's when you think about the concentration risk for a lot of these credit unions. I mean, Val, you've seen the numbers. I mean, could we be doing more when it comes to flood and natural disaster risk in a lot of these areas?
Sure. And my perspective on this, of course, is through the data lens. And one such information source for understanding what we can do better or more is the American Community Survey data. So that data has information about homeowners insurance, and you can use it to analyze what percentage of you in your community does not have home insurance, for example. So actually, speaking of Western North Carolina, when we filter to Asheville, North Carolina, we see that about 9,300 owner-occupied households had no home insurance, and majority of them are actually owned free and clear. So when we talk about mortgage, somehow the presence of mortgage gives that discipline of homeowners to take or to seek home insurance due to the requirements of the lender or the investor of that loan. But what I think, based on my observations, what credit unions can do is number one, understand those dynamics and then reach out with that knowledge to the community and talk about the importance, educate the members, because the chances are that some of those 9,000 households are probably a large portion of them were credit union members. So using data to reach out proactively to open a dialogue about the importance and just show some kind of statistics like that, I think is going to engage the members and will help both the members and the credit union begin to brainstorm for ideas, whether it's a home improvement loan or second lien, and so forth.
Okay, perfect. And I think that's an excellent segue to the next question and really this topic. The critical steps a credit union should take immediately after a natural disaster to ensure uninterrupted member service and maintain that trust, right? And really, this can go to anybody, right? And so, I think there's certain steps that we are required to do to protect our portfolios, right? But there's and maybe there's some compliance steps we probably should do as well. Mandy, any thoughts on this?
Yeah, I mean, immediately following a disaster, right, you've got multiple things going on for not only the credit union, but the members. I think there's a fantastic opportunity just from a member service perspective. So not even necessarily compliance, but we know our credit unions care about their members. And so to be proactive in the reach outs, whether it's, using technology, using credit union apps on your phone, not necessarily just email, but also for non-members, providing, that service. It could be a way to show the value of a credit union, right? And the member service perspective. I mean, by the time you get past a natural disaster, a lot of it's not as much compliance as it is trying to clean up after something terrible has happened. A lot of our compliance obligations are more on the front end, particularly related to flood and disclosures and insurance and all of those kinds of things. But after something happens, I think just the nature of our credit unions and our relationship with our members and extending that relationship in a time where a lot of members are probably feeling overwhelmed and being a resource to those folks.
Okay. Steve, Val, any thoughts on the critical steps we should immediately take?
Well, I would, if I may, continue my conversation or my thought process on the data. We mentioned the flood risk, the FEMA data. The data contains actually the FEMA National Risk Indicator data contains 18 different hazards. And the thing with disaster is that these are measurements of frequency and the expected annual loss that those sources provide. But the reality of disaster is that it is sudden. And then when we talk about the credit union model, it's usually localized and the effect is outsized. So my suggestion is to really get yourself educated with the FEMA data and your exposure to the 18 different types of hazard risks that have all of them typically very small chance of happening. But as we saw in Western North Carolina, this was like 1 in 2 centuries event that took lives, brought incredible devastation to a region that is mountainous and so forth. So for me, I think that getting into this year and the next year, getting our arms around the data, understanding what those risks are, is the first step in order to know how to prepare. As Mandy said, when the disaster risk happens, all you can do is just clean up after that, and it is very painful and heartbreaking. But what can you do to be proactive by knowing what the risk exposure is?
Well, I mean, I think you bring up a good point. I'm sorry, Mandy, please.
No, I'm sorry. I was just going to say it's an interesting point in that data, Val. Like you mentioned, there's all these different disaster risks. So you think about a state like Colorado, where Steve and I are, and folks who live in the foothills and the mountains and are subject to forest fire risk, or gosh, what we saw happen in California last year.
Mhm.
And for our smaller credit union members, understanding, knowing that they are in a region and they don't necessarily have the same opportunity to avoid that concentration, like understanding what disasters your members are at risk for, and just knowing in advance, even though fingers crossed, right? We hope they never happen.
Yeah.
Right. But and you know, and I was just, and I think that's both of you make good points, and it kind of segues to what I was about to say. It's almost like the Achilles heel of some credit unions that we often don't talk about. You have, national-based lenders for credit unions, but then you also have regional and community-based lenders for credit unions, state chartered or community-based chartered credit unions, right? The ones that are state chartered, in many ways, are naturally by design are going to have these concentration risks, and that they just can't help because in some ways they can't go outside of this footprint, right? And so if you are a community-based credit union that's stuck in a certain geographic area, you're going to have a natural concentration risk if a hurricane comes in and hits your community. It's just going to happen. So how can you support? Steve, were you going to say something?
There's a whole nother dimension to this also, which and I agree. The focus is on the members and the mortgage loans and compliance and all of that. But credit unions also have facilities. Credit unions also have employees. When disaster strikes, credit unions and their employees are not immune to that also. So the mindset of preparedness is important as it relates to uninterrupted service, preparing for your own operation.
Right. Good point. Excellent point. Next question in this topic, and it's really the last question I have in this topic before we transition to topic number 2. How can credit unions proactively prepare their members financially and really operationally to be more resilient before a natural disaster strikes? And I find this question interesting because when you think about it, and I'm going to add some preface to this, if you think of like a state like Florida, right, where 16 insurance companies have left in recent years, or even Louisiana, when a dozen insurance companies have left in recent years, how can you help them prepare for natural disasters like a hurricane or flood or something like that? Or, I mean, California recently allowed Allstate to increase wildfire insurance by 35%. I mean, how can you help them prepare? How can a credit union proactively help their members prepare financially or operationally for these types of things when it's many ways out of our control? Anyone?
I'll beat the drum again. You know, mandatory purchase for flood insurance, which it's not the same for all other natural hazards, but specifically for flood insurance, would take care of many of that. There needs to be the mindset, though, that even if there's not a mandatory purchase requirement, there can be flood risk, and helping members understand that is important. You know, obviously, information. I do not sell flood insurance, so don't get me wrong, but giving information on flood risk outside of the mandatory purchase is useful. I think also there's things besides flood insurance that can help in preparedness and mitigation. There's resources available. If you go to FEMA.gov, FloodSmart, other sites, they have information on this exact topic, how to proactively prepare for natural disasters, and very specifically flood in those two instances. I think a good practice for a credit union would be to take that information and make it your own. You know, prepare a slick. I'm old school. Prepare a link on your web page that gives information to your members about how to prepare and be better prepared for events, particularly if you're in Louisiana or Florida or these high risk areas.
Okay.
And I would agree with this. Sorry, Mandy.
No, you go ahead, Val.
That, you know, giving information and engaging in an open dialogue with the members is probably the best way. There is never going to be the perfect preparing the members financially to face disaster, because that's the definition of disaster. But if the credit unions engage on a regular basis, it becomes part of the conversation, and engage the members in thinking about that, people will find ways to figure out how to improve their homes. For example, if the biggest risk is riverine flooding, and when a hurricane comes, like what happened in Western North Carolina, maybe this flood risk is the most important. So you can begin to prioritize conversation there and provide resources, how best practices, how to improve those houses, homes, single family, multifamily, and so forth. And for the credit union, that would be hardening the asset that collateralizes the mortgage.
Okay.
Val, it's funny, you struck my memory on, we had this similar conversation at Acumen Annual last year where we were talking about, okay, beyond flood, how can members sort of mitigate some of the potential problems? And we talked about things, you know, home improvements. So you're in Colorado, you have a really high risk of worsening hailstorms. So not as much as California, Peter, but we've seen homeowners insurance rates in Colorado go up dramatically because hailstorms are becoming more frequent and severe hailstorms are becoming more frequent. So things like getting impact resistant shingles when you replace your roof. And actually insurance companies will lower your premium for that. So you get sort of a win-win. And if we can educate our members on, oh, if your roof is bad and you do impact resist, you know, check with your insurance company. Obviously, we don't sell insurance. We are credit unions. But if you get an impact resistant roof, not only are you lessening your chances of a destruction again from a hailstorm, but you might get a break on your insurance. The same kind of, along those same lines, Peter, I was thinking about what you said about California and those rates. It's wild from the fires. But I think a lot of times people get in a pinch, their premiums go up really high, so they raise their deductible to lower their premium, but not thinking through, okay, then if a fire comes, I can't afford that deductible. So making sure, you know, whatever educational consumer outreach resources we can provide around, like there's trade-offs to everything. If you raise your deductible and lower your premium, but down the road something terrible happens and you can't afford your deductible, what are you going to do?
Right.
So, and we also talked about, I remember about, you know, if you live in the foothills and you're in a wildfire risk, are there, you know, can you cut back trees further away from your house to protect the potential of the fire getting to the actual structure? There's all kinds of mitigation that folks can do if they know they can do it.
Right. You know, it's funny that you mentioned the shingles and insurance company providing discounts, just like we have Energy Star improvements, and oftentimes they are now required for new constructions. What about this crazy idea that new constructions are required to have ASTM materials as part of that build? So ASTM is typically rated for some form of weather resistant material. For example, a material that is rated ASTM D3 can withstand winds up to 150 miles per hour. So why not required in certain geographic areas, like we'll say Tornado Alley, that homes be built with that material, right? It's just, I don't know. Maybe I'm just going down a rabbit hole. But anyways.
Yeah.
No, I don't think so at all. But I think we're battling, you know, we're in a market where homes are so unaffordable for so many people. And so there's resistance, I think, to some of these things because they may be more expensive and therefore make housing costs more expensive. So again, like everything's a trade-off, right? The same thing, you could say the same about certain types of windows. Instead of vinyl windows, you could say we need to do Fibrex because they're A, more energy efficient, B, less likely to warp, C, more resistant to things like wind and hail. But they are more expensive. So then you're driving up the cost of the home. And so in this market where we have this unaffordability issue, I think you're seeing resistance to some things that otherwise folks would say, yeah, that's a great idea. We should do that because it makes things even more expensive. So
Yeah, so but give and take, right? So
yeah,
in the DC area where I don't really have tornadoes, I don't need to build them.
cross your fingers.
I mean, right now I don't have tornadoes, and I'm knocking on wood right now, but and maybe in Tornado Alley, maybe that is required, or where there's a lot of places that have a lot of hail, yeah, you build, you require places to have good shingles. Anyways, let's move on to topic 2, just for the sake of time. We are pushing it already. Time flies when you're having fun. Topic 2, policy changes and FEMA's role and how this might have an impact on lending. I'm going to jump around just for the sake of time.
Yeah.
We know that there's mandatory purchase of flood insurance requirement for high-risk properties. What challenges do you see credit unions facing with flood regulation compliance? Steve, we're going to come to you first.
Okay. Yeah. Well, again, I'll say um, that credit unions are generally compliant. That's not a huge issue right now, and certainly as it relates to originations, it's pretty straightforward to obtain a flood zone determination. If they're in a mandatory purchase requirement, make sure that adequate flood insurance is in place, for loan closing. More challenges, I do think, come with changes down the line. So where there's a life of loan product, and there's a map change from FEMA, and it moves a member into a special flood hazard area. There's notice requirements that need to be followed. it's a shock to the system oftentimes, some pushback from the member. We do know that it's better for everybody if the member obtains flood insurance on their own versus the credit union going through a forced placement. So, following that practice and making sure you have good policy, procedures in place would be important. The other thing I would point to is, well, we don't know where, we do know things are going to change. We don't know where the changes are. FEMA, government agency, federal, Washington's in a new environment right now. So we really don't have a good idea of the path that's going to be taken. But change is very likely, and staying on top of what is going on with the National Flood Insurance Program in particular, with FEMA in their various roles, because FEMA certainly is involved throughout the process with hazards and disaster relief. So staying on top of that, and I would also say, I'm sorry to be jumping around, but the states are starting to get involved. So we saw several years ago Massachusetts had an additional requirement going beyond the federal requirement. New York this year has adopted a different requirement, and there's notices that need to go to the borrowers that are in the high risk area in the mandatory purchase. So making sure that your vendor is providing the requisite notices for those states in addition to the federal notice would be something that's important. So, you're kind of hit from all areas, all angles. It's just very important to be engaged and involved and aware of what changes are coming down.
Okay. It's interesting. You referenced high risk, right? And so, but when you look at areas, I want to say, a few months ago, CoreLogic published this. It was almost like a heat map of migration for the PAT from 2000 to 2023 of the migration of where Americans moved to, and it surprisingly, people moved to high risk areas. And when you look at Florida as an example, which is a very high risk area, between 2000 and 2023, millions of people moved to the state of Florida. But then when you look at Florida in general, 9% of the population doesn't even have insurance at all. So it's how can a credit union protect itself when when the 9% of that population doesn't even have any form of insurance?
Yeah, I don't have a good solution for you there. I will add to that. A study not too long ago came out and really detailed that even to the next level, where there's a disproportionate amount of properties, and we're talking about residential properties here, that are near but not in the highest risk areas. So the mandatory purchase special flood hazard area. There's many properties that are, and I'm not blaming builders. They're doing what they should do and to maximize their profit, but they're, elevating with fill these areas and through letters of map revision, having the mandatory purchase removed, or they are purposely building in desirable areas, but not in the special flood hazard area, but they're near the special flood hazard area. So we have a disproportionate number of people who are just out of the highest risk zone. They're not required to have flood insurance, and they tend not to get it, but they are still in a relatively high risk area. That's that moderate risk area. These people oftentimes will encounter a flood event during the life of their loan, and they're typically not covered by insurance.
Okay. Next question, I'm gonna come to Val and Mandy for this next question. From a compliance standpoint, what potential risks or pitfalls might credit unions overlook when responding to policy shifts? Val, I'm gonna come to you first.
Well, from my perspective, I think especially now things are changing so fast, so quickly. So I guess the biggest risk is not noticing what's happening because it's happening so fast. And for example, the FHFA director Bill Putty posted today on X that he's rescinding one of the advisory bulletins. So things are changing. So this was a climate-related risk management previously advisory bulletin that was was accepted during the Biden administration, and now in this administration it's canceled. So maybe you have started working on that and trying to align yourself with some of those best practices from the GSEs, and now things are different. You know, this kind of uncertainty, and credit unions might miss something like this. But also from what I think is going to happen in general in the mortgage industry by canceling this climate-related risk management, the risk of managing is going to go back to the lenders. So maybe credit unions will be affected as well, even though a small portion of the GSE's portfolios are coming from credit unions, but still you have to learn how to do those risk assessments, how to put risk management practices in place without reference to this bigger framework for risk management when it comes to climate-related risks.
Okay. Mandy.
I completely agree. I think the biggest thing is monitoring and having a good monitoring program. As we see things changing so quickly, Steve, you brought up a great point, which is, you know, depending on what happens on the federal level, we may see more and more states starting to step in and become more active. And so not only being able to monitor the federal laws, but what's going on in the state laws. And then I wouldn't be a compliance professional if I didn't say that not only monitoring, but implementing those from an operational perspective. So as changes are coming through, make sure that you're operationalizing everything and training, and then test and make sure that you don't have any gaps. And if you do, start that circle all over again, review your policies and procedures, update them, train your personnel. It's a monumental undertaking for the compliance teams to do it, but there are luckily lots of great resources out there from Acuma and ACEs and others. Kyle mentioned the Compliance News Hub and Compliance Calendar. We publish all that we can to folks to try to help with that. But operationalizing those changes after they come is the next step. And you just have to do it.
You know, this reminds me of one of those things that once you finish, you have to start it back over again.
It's the circle of compliance.
That's right.
It just keeps
Right.
going.
That's right. All right, let's move on to topic 3, just for the sake of time. We are over, but that's okay. We're still under the hour. Topic 3 is concentration risk, portfolio resilience, and disaster-prone markets. First question is, what specific analytics or portfolio management tools do you recommend for identifying and mitigating geographic or property type concentration risks in mortgage portfolios? Val, will come to you first.
Well, the biggest one is the MBS loan level performance data that comes from the GSEs. And there it goes to the zip code level. So when you match it with the NRI data, then blend that information with the NRI data, then you can get a sense of the exposure of that particular location to a particular risk. And you can measure delinquencies due to disaster risk. That's one of the reasons, for example, that exists in Freddie Mac portfolio. You can look in that data and see what is the delinquency due to disaster, and then benchmark it and see how internally how your portfolio matches that. And I'll give you an example with the California wildfires. there were 13 zip codes that were that Governor Newsom declared as disaster zones, and that's where the forbearance was. The banks and the other lenders were announcing forbearance and other loan modification activities for borrowers and help for borrowers that were affected in those areas. But when you look at the latest data, which is September, so this is before the disaster hit, but there the disaster is very small. So delinquencies due to disaster are 0.01% of the portfolio in those select zip codes. And then statewide, this kind of delinquency for Freddie Mac was 0.03%, and nationwide it's 3 times that, 0.09%. So the point of that is that it's a very small percentage, but when it hits, it's this concentration of it that, and this is, as I said, these statistics are before the wildfires because we don't have the data yet. But this is, I would say that this kind of loan level data and measuring would be the best to follow and to know where you stand based on those industry benchmarks.
Yeah, but it's even though it seems like a small percentage, right? But if you think about it, when you look at the LA wildfires, and I'm just going to use as a generalization, 86% of them were single families, right?
Mm-hmm.
And when you make it a dollar amount, 35 to 45 billion, right? Yeah. Pacific Palisades, the average home was 3.4 million. I mean, those are large dollar amounts for any
Correct
mortgage portfolio.
Yeah.
So it's good to have this type of resource, even though, yes, it's a small percentage of an MBS portfolio. It's a large dollar amount for the individual loan.
Yeah, especially after the fact, after disaster hits, then you tally up all those losses, and usually the impact is much bigger. They're just because also due to the disruption and sometimes complete destruction, like in the Palisade wildfires case. The NRI has a measurement called the estimated annual loss, which is usually in the millions. And in going back to the Western North Carolina example, there the estimated annual loss is about 100 million on an annualized basis from riverine and hurricane flooding. But after the fact, the state tallied up the losses and they are almost 60 billion. It's a huge amount. And then we are not even mentioning the loss of life in that. 103 people died in Western North Carolina. So it's a huge impact. But I guess the keeping the pulse of what's happening in the GSE's portfolios, especially on counts, the statistics I gave you were on counts. It's that frequency of the event that prepares you and you know what to expect. Generally speaking, at the very least, your portfolio should not be worse than what the average of the industry is.
Okay. Steve, any thoughts on this?
I agree with Val completely. It's about data. Unfortunately, flood's a fickle thing, not knowing where the next flood event is going to hit. Yeah, we know flood-prone areas, but we don't know where the new ones. Nobody expected Asheville. We do, at least there are tools and data available that can help from a historical standpoint. I mean, we have data that will show the number of claims and dollar amount of claims by community. So, a credit union with the concentration in a particular area can get data that, at least from a historical standpoint, can give relative risk, flood risk data elements. So there are some good tools available for that.
Okay. Last question before we transition to final thoughts. Is there a magic number? And when I say that, is there a magic number that a credit union should find balance of between meeting community needs and managing concentration risk? Is there such a thing? Mandy.
On the hot seat. I don't think there's a magic number because I think there's so many variables, right? How big of a credit union are you? Do you have an ability to spread out your risk? Are you really, really prone to concentration risk due to a regional aspect of your membership? And frankly, there's a lot of risk tolerance questions to be taken into consideration too. So sadly, I don't think there's a magic number.
Come on. That's a very good attorney answer.
That's right. That's what I'm here for.
That's right. That's right. Val, any thoughts?
Well, I would agree with Bandy, even though I'm not an attorney. I'm a data scientist,
Always
mortgage
fall back
banker.
on your attorney.
Yes. But it is because of that situation. Every credit union is different, and the size matters, and the location matters. And for me, you have to find a way to look to use your business model to see what that magic number is. But you have to have the data in order to say why you settle on a certain magic number. And let's not forget that in mortgage lending, not only that we have to protect portfolios, but we also have to comply with fair lending regulations. So we know that many of the households who live in disaster-prone areas, not always, but often, especially in tornado lanes, are low to moderate income households. And so excluding them, that might not look good on the other side of the risk spectrum, which is the fair lending. So you might be good on the disaster risk, but then maybe crossing the fair lending risk. So I think just getting a hold of the data, analyze it, and then say what you're prepared to do, document it, and then build your strategy from there.
Okay, very good. Steve, real quick, can you answer this one real quick?
No, I'm glad you asked Mandy to go first, but I have nothing more to add from that one.
Okay, good. All right. Any final thoughts before we end?
Well,
We'll go Val first.
Sorry, I interrupted you.
No, give me some final thoughts, Val.
Okay. Well, for me, data is lifeline. And then when you're in a region that is vulnerable to natural disasters, if you have this ability to tap into the data and do the analysis to find a magic number or this good strategy to manage all the risks, not only one, is going to be a game changer. And so tools out there with open data like HumDivision, NBS Pivot, Census Vision that blend those data sets that, at least in my case, I spoke about, are going to will be able to deliver actionable insights for an actionable strategy for disaster management.
Perfect. Mandy.
I would just say, as a closing thought, don't forget your compliance basics. All of this can be very, very overwhelming. But as long as you arm yourself not only with the data, but the information around your compliance obligations and stick to your circle of compliance, that'll help you from a compliance perspective. Just don't forget the basics. It's easy to get lost in all the minutia.
That's right. Steve, final thoughts.
I'll go with communication with your members. Again, flood specific here, but first of all, your team should certainly not be saying you don't need flood insurance when somebody is not in a special flood hazard area. It is appropriate to say you're not required to have flood insurance as a condition of the loan, but don't sway people the other way.
Okay.
I think also, just having the team having a mindset that flood events can financially run your members, and you want to help them avoid that in every way possible. And yes, it goes well beyond trying to promote flood insurance, but providing information. As I say, I mentioned earlier the thought. I think it's a good practice to have some preparedness information, whether that's a a slip to hand out or a link on the web page or something. There's a wealth of information out there, and I think it would be mutually beneficial both to the credit union and your members to to provide something along that as it relates to natural disasters.
Fantastic. Well, thank you all very much for spending time with us. I truly do appreciate it. And I guess we'll see you soon. Thank you.
Thanks,
And to
Peter.
quickly
Thanks for
close
having
out,
us.
Thank you.
of course, my pleasure. And to quickly close out, thank you again to Kyle and ACES Quality Management for sponsoring today's webinar. And again, to Mandy, Val, and Steve for their valuable insight. And to all of you, thank you for attending today's webinar. And we know your time is valuable, and we hope you appreciate spending the better part of an hour with us today. We know that really 45 minutes isn't really enough time to cover everything in this topic, so we really didn't. We hope you desire to want to learn more and continue the conversation and fine-tune your knowledge. I'd recommend attending one of our upcoming events or listening to one of our podcasts, where you'll find that we'll continue to expand upon this topic and much, much more. Head over to www.acumen.org or our community page for more information on the latest updates on everything happening over at Acuma. Until next time, be well, my friends. Bye.